Hello there. Welcome to Learning Finance with Anish Shankar. Today we are going to be looking at a topic called risk analysis in capital budgeting. For those of you who are kind of following the channel, last time we spoke about the basic concepts in capital budgeting. Essentially, what is capital budgeting? What are the different techniques we follow? We looked into why cash flow is better than profit when we want to analyze investments, and we went into certain techniques like payback period, net present value, IRR, profitability index. So one of the assumptions we made is that when we estimate cash flows, we accounted for the time value of money. We used the cost of capital to discount cash flows and bring them to present value. So today we're going to be looking at this topic from a slightly different perspective. What we're really going to look into is how certain are we that our forecasts that we make on, say, the amount of cash flow that we're going to receive will actually kind of pan out in reality, right? Because we're estimating future cash flows well in advance, and most capital budgeting projects might be 10, 20 years in, it might be that big of a project. So in that case, when we're forecasting cash flows that far into the future, there's high amount of uncertainty, and we need to kind of like test different scenarios. What would happen if the amount of cash flow that you receive is far lesser or even far greater than what you receive? Are we prepared for that? So it's really about that we're going to study this week. And so the risk analysis, why does it matter in capital budgeting? So these decisions are made up front. They involve substantial amount of investment. Returns come in the future. Since the future is uncertain, we are kind of like relying on point estimates, and that's a problem. So we would like to have a range of values to kind of understand if it's in a high growth area, what would the range be? If it's low growth, then what would the range be? Depending on market circumstances, interest rates, price movements, geopolitical risks. So all these things add to uncertainty, and the idea that we're trying to do is to mitigate the risk by knowing what outcomes might emerge. So some of the techniques that we can use and we're going to look into are shown here: certainty, equivalent, risk adjusted discount rate. There's using the mean and standard deviation techniques, decision tree analysis, sensitivity analysis, scenario planning. So those are some of the techniques that we're going to look into, and the idea behind this is not to kind of get any certainty. Like there's again, everything is forecasting, everything is expecting, but what we're trying to do is be prepared, have the information that if something doesn't turn out, what would we do? Should we get into this project? If we want to get into this project, what kind of capital bands we might require? How much time do we need to spend on this, commit on this before, let's say, abandoning the project or declaring it as a loss? So that's the kind of thing. And then we also want to know what all variables can impact our project. If some conflict in a far off land can affect the price of, say, a commodity or an agricultural product, it's no use saying that it's not relevant. Everything is relevant. So it could be some small thing, it could be geographically distant, but still we need to factor in, we need to look into, say, the supply chain, all the various parts that kind of like interact with the business and understand it. So we go from very, very simple techniques like certainty equivalent to the most complex one, that's scenario planning. Let's dive into some of this. So the first concept really is certainty equivalent cash flow. Now the concept behind this is that we try and estimate what part of the cash flow we can at least expect, be certain of receiving, right? And so if, let's say, in this example that we have here in year one, we expect to get about 50 lakhs in revenue. What portion of that is actually certain? This again is an estimate, it's a guess. We have something called the certainty equivalent coefficient, and that's just a probability number between 0 and 1 that kind of predicts what part of that. So in this case, 0.6 or 60% is what that indicates, and that's 50. So if you want to know the certainty equivalent cash flow, that will be 50 lakhs into 0.6, that's 30 lakhs, which would be the certainty equivalent cash flow. The idea here is to kind of be a little bit more conservative. Again, how do you arrive at 0.6? You probably have to use a varying degrees of, let's say, market demand studies, production outputs, all that would kind of like impact into something like a CE coefficient. And so the idea here is to kind of like discount the cash flow by the certainty equivalent coefficient to kind of get a much more conservative estimate of what your inflow is. And then you can use the standard NPV techniques to kind of like discount the inflow to present value at the rate of cost of capital to get the to calculate net present value. The only difference being here that we are preemptively discounting the raw cash flow by a certainty equivalent that kind of like helps us predict what is the chance of our cash flow actually materializing. So some of you might be thinking, well, why are you doing this double discounting? Isn't there a way where we can probably incorporate this in the present value calculation itself? And yes, we can do that, and that's where risk adjusted discount rates really come into the picture. The risk adjusted discount rate essentially is trying to find different discounting rates for different types of projects. So depending on maybe the amount of capital investment, about the newness, like for example, if you're adopting a new technology, then it's not just the risk of implementing that, as in building that let's say machinery or plant. It's also training the resources, understanding let's say maintenance schedules, those kind of things. Then that would add additional risk to the cash flows. It could maybe halt production, create production issues. You may not be able to be as productive as possible. So then having a risk adjusted discount rate can really helps you kind of like factor these things into account. So instead of having a CE cash flow or a CE coefficient, you can just adjust your discount rate to reflect that risk as well. So if your cost of capital normally is about 10% and you're going to take an extremely or excessively risky project, then you can say, well, for this project I'm going to calculate 15%, and that would factor the additional risk, and you can directly kind of discount your cash inflows to present value using the risk adjusted discount rate. So those are two techniques: certainty equivalent cash flows and risk adjusted discount rate. So next we go into another statistical technique, one that uses probability, and that's decision tree analysis. So decision tree is a tool that's employed in capital budgeting. What we want to do is evaluate the various different alternatives that may emerge and what is the impact of each alternative emerging. The thing with the decision tree is that it actually visualizes the set of choices that you can have and the outcomes that you can expect based on each branch following its logical end. So essentially, the process involves identification. You list and identify available investment options along with potential outcomes. You assign probability values based on market conditions, economic factors. Like that is subjective, but still you have to take the best guess that you can do. You create the expected monetary value for each decision alternative, ideally by multiplying the probabilities, and finally the one with the highest one gets is the one that you accept. So if you look at this is an example. So imagine you have a project and the outlay is 60,000. In the first year, you expect, now you could say you expect 50,000 rupees, but that's a single value. It's highly risky. So instead you say there's a 40% chance of getting 35,000 and a 60% chance of getting 45,000. And then now if that was just that 1 year, all you had to do was multiply the amount into the probability and you get your expected cash flow for that year. Now since it's multiple years and multiple probabilities involved, you probably want to get the joint probability. So for example, there's a chance that you invest 60,000, that much is relatively clear. The first year you get 35, there's a 40% you're getting 35,000. And then there's three other alternatives. There's 20% chance of getting 15,000, a 30% chance of getting 18,000, and a 50% chance of getting 25,000. So then you really want to know what is the job. So you kind of like start from the end and go backwards. You want to look at what is the probability of each outcome happening, and so you have this joint probability. So for example, there's an 8% chance that you'll get 35,000 in the first year and 15,000 the second year. That's 50,000 rupees. That's probably your lowest estimate. And at the other side of the spectrum, you have a 6% chance that you'll get 45,000 the first year and 40,000 the second year, and so that's about 85,000 in total. So that's really the range of probabilities that you can kind of like span across. And so as you can see, this really helps you understand what the different outcomes are based on the decisions you make. So it's a really good visual representation, and it helps you understand. And if you want to choose the one that gets the maximum value generation there. So we'll dive deeper into that in a later video, but this is just like a high level overview of what a decision tree is. Next, we move to something called sensitivity analysis, and the essential idea behind this is it examines the impact of changing key variables on a project's financial performance. So if you, let's say, look at an NPV or a project, let's say where you're buying machinery, the question is like you make certain assumptions that maybe the machine will last for 10 years. Maybe this is the cost of capital is 10%. This could be based on, let's say, the current inflation, or let's say the risk-free rate of return, which over 10 years could change. And then again, the amount you expect to come in, the cost savings or the sales that you expect may not materialize. There might be cost overruns. So then how do you understand the impact of each of these variables on the project? So you want to isolate each variable and see how does that impact your project. It kind of helps you understand if your project is susceptible to any specific thing. For example, if life is a key critical dependency, we expect it to go for 10 years and it's important that it runs for 10 years. If it breaks down in the 6th year or 5th year, and that could spell trouble for your project, then it's important to know what is the sensitivity of time. It could be obsolescence. It could be that the product it makes is losing market demand. So all those things can impact. So you want to understand exactly how important is the cash flow that you've determined every year to the success of the project. So if by how much can it vary? If it can vary by 30%, does it still make your project relevant, viable? So that's what sensitivity analysis tries to kind of like understand, and tries to isolate what is the weak point in your analysis and in the investment proposal. So it's a tool for planning. It's to identify contingencies and kind of plan for it. So that's what it is. So a slightly larger. So some of you may have a question. Well, what about if multiple variables happen at the same time? How exactly would you measure the interaction between those variables? Well, for that we have something called scenario planning, and scenario planning essentially helps in kind of like formulating different scenarios where different things happen at the same time. So this could be something like the oil price going up, inflation going up, so interest rates going up. It could also mean that people are cutting down on spending because inflation goes up, so your demand falling. So what happens there, right? The counter scenario actually is, weirdly enough, is when demand rises significantly. In a boom cycle, everyone's rushing to kind of invest. Prices go up for everything. You need to kind of like understand what is the impact and intelligently invest to increase capacity. So how do you do that? So both, whether it's a bust cycle or a boom cycle or like the base performance cycle, we want to look at different scenarios. You want to identify variables and do what if scenarios. So that's another thing, and it helps you understand exactly what are the different variables, how they jointly interact, and what do you need to do for managing risk, and how you can predict change and help make better decisions. So these are some of the techniques that we do. Scenario planning is something that's it's much better using computer modeling, Excel, and we'll probably do a video later on how you can use Excel to do what if scenarios. And there's some great forecasting tools in that as well. So we'll look at that, but this is an overview of the risk analysis and capital budgeting. These are some of the techniques that we use. They each have their own strength. We'll look at them in each one later in detail in later videos, but I just wanted to make a quick video to explain some of the high level overviews here. All right then, see you next week.